Are you considering investing in property? Well, if you are, likelihood is you're going to need a buy-to-let mortgage. In 2023, there were over 83,400 applications of this type, and they are different to your normal residential mortgage. And in this video, I'm going to break down those differences, all in a bid or an aim to try and save you some money and make for a more profitable investment, while answering some commonly asked questions as well while we go through the video. If you're in a position where you can buy a property outright, let's say, I'll also answer the question in this video of potentially it might not work out better to pay for a property outright and still look at a mortgage. There are three things which I find commonly worry people about looking at this kind of thing. So firstly, it's high repayments, financial risk, the association that having debt is bad. So obviously there are some forms of bad debt out there, but I take the view that there are some forms of good debt as well. So I'll go through these areas individually and I'll obviously explain why they don't worry me and what you can also have in place to put your mind at ease a little bit. Just taking a step back, so one of the first key differences is they are looking at the property more than they are you. But the thinking is, because you'll be collecting rent, that's what will be used to make the mortgage payments. But at the end of the day, it is still you that they're lending the money to, so they do still ask some things of you and your circumstances. First one being that you're earning about £25,000 a year in income. This does vary. Some can be a little bit higher, some potentially a little bit lower as well. But that tends to be what it looks like. If you're employed, they'd ask for your latest pay slips. If you're self-employed, they'd ask for your latest couple of years self-assessments or tax returns. And then just of your circumstances as well, they'd usually ask that there's no adverse credit or very low amounts of it. So by adverse credit, I mean CCJs, so county court judgments, late or missed payments, because they are just making sure, doing their due diligence, that you are going to pay them and pay for the mortgage. Commonly asked question being, can you buy an investment property with a mortgage if you don't own a residential home first? It all depends on your circumstances, but depending on them, you can. It is something that's possible, but it does restrict the amount of lenders that are available. First thing I wanted to address was those high repayments. So when you buy a property to live in, you usually get it on a repayment basis. So what that means is every time you make a payment, some of that goes towards paying off the actual mortgage that you owe, and then some of it goes towards paying off the interest that you've sort of accrued or built up by borrowing that money. And then over time, your mortgage balance drops and drops and drops. When you get to the end, you're mortgage free. With a buy-to-let, a lot of people choose to have this on an interest-only basis instead. So what that means is, let's say you borrow £150,000. At the end of it, you still owe £150,000. So you're still only paying for the interest. What this means is the monthly repayments are going to work out less than your normal mortgage does. In the short term, for investors, it means your cash flow, your profits are going to be higher. You can take that and you can invest it again. In the long term, this also works out beneficial, and this is because of inflation. What inflation is it's the cost of goods going up over time, and that means your money buys less. That means, technically speaking, your money isn't as valuable as it was. So it's the same thing as, let's say, Freddos and their extortionate prices today compared to what they used to be. It's the same thing that means a loaf of bread is more expensive this year than it was last year, but it's the same loaf of bread. Well, you say that, they've probably made it smaller in a way, you know what they do. But this works in the same way with debts. So let's say if you borrowed £150,000, after 10 years, that money at that point would be worth a little bit less than obviously what it was worth when you first took it out. So if we took 2-3% a year in inflation, after 10 years goes by, it might actually be in real world value about £105,000 to £115,000 worth of debt, although technically speaking it will still be £150,000, if that makes sense. In reality, it means the value of the house is going to go up, you're going to get pay rises at work, and naturally, as always, the market value of rent is going to go up, so naturally your debt, your mortgage is going to be relatively the same, but you're going to be able to charge more in rent. If you are a little bit unsure about interest only, some lenders, they do just allow you to change to a repayment mortgage sort of midway through, and it's nice and straightforward, and you can also overpay with a lot of mortgages. They'll give you a certain amount that you can overpay each year, and you can still pay down that level of debt even if it is on interest only, but you're in a lot more control around it. So the next thing that's taken into consideration is something called the loan to value. So this is basically a percentage based off of how much the property is worth, how much are you borrowing. So as an example, if you looked at a property that was £100,000 and you borrowed £75,000, that means your loan to value would be 75%. So you're borrowing 75% of the value of the property. The way this kind of works is the higher the percentage, the higher the risk you're seen as to lenders, because obviously you're borrowing more of the value. The main thing to consider with buy-to-let, so with your residential mortgages, you can do anything from a 5% deposit to, well, upwards to however much you want. In general, people might put 10 to 15% for a deposit for a residential mortgage. With buy-to-let, the average tends to be around about 25%. So again, same scenario, you need to put down a £25,000 deposit if you're looking at a property value of 100,000. Some lenders, they do allow you to do a little bit less of a deposit, so round about an 80% loan to value. But again, this is one where it restricts the amount of choices that you do have available. Moving on to another point, that debt is bad. Just all debt is bad. If, let's say, house prices were to go up 3% per year and your return on investment on a property is 6%, that being obviously the profit you're making from the rent. So that's 9% per year this is giving you back. And this might be on a mortgage where you're paying 4 to 5%. Is that necessarily a bad debt? Is just one thing to consider. It's a very distinct difference between looking at a mortgage where it is an investment versus a credit card where you're paying 25% in interest over that time frame. They're two very different things. Another way to consider it is, let's say you've got £100,000 to buy a property that goes up 3% per year, just as an example. After 5 years, it might have gone up about £15,500 to £16,000 in value over that time. Instead, what you could do is you could take that £100,000 and do 4 £25,000 deposits and then mortgage the rest of it. Now you've got 4 properties that are appreciating in value. So instead of, let's say, £15,500 over 5 years for one property, you've got that coming in over 4 properties, which is what, £62,000 for utilising the same money in that way. There will be other factors to consider, such as additional legal costs, stamp duty, potentially capital gains tax as well. But it's just a way of showing that by utilising that same money in a different way, by leveraging that money, you could get a much better result. So the final bit to consider that you might be a little bit nervous of is that financial risk, and naturally lenders are going to be nervous about it as well. The way they console themselves is by stress testing the mortgage payment against the rent that you're potentially going to earn. So what I mean by that is, if you're a basic rate taxpayer, let's say, so you're on about £50,000 or less per year, this will obviously vary depending on when you're watching the video, so I'd say it's always best to go to the Gov website. But let's say if you're a basic rate taxpayer, it's 125%, so that means that the rent has got to be 125% of the mortgage payment at least. So let's say mortgage payment is £500 a month. Your rent has got to be about £625 per month for them to be fairly comfortable with it. Again, this is very rough and it will vary. If you're a higher rate taxpayer, so usually this would apply if you're on over about £50,000 a year up to about £125,000, this number's more likely 145%. Then this can go up to 165% if you're an additional rate taxpayer, so earning over about £125,000 per year. With that financial risk as well, you've got landlord insurance, where this can vary from legal expenses, so for whatever reason you might end up going to court, right down to payment protection. So if a tenant stops paying rent, this will cover the rent payments that are missed out on as a form of insurance and as an additional way of getting that peace of mind. As with residential mortgages, you'll have your fixed rates and your variable rates. So fixed rates, the payments stay the same each month, and so does the interest rate for a certain period. And variable rates, they'll change and adjust based on the base rate that the Bank of England is looking at. The best one for you, it will be very dependent on your circumstances and when you're watching the video as well. So the main thing is to just get a good mortgage broker on your side that will guide you through the process. So where do you go from here? So you want to identify an area that you want to invest in. From there, that will tell you purchase price, how much of a deposit you might need, Find yourself a good broker. Their fees will vary from £300 to £1,000. For that, they'll do the affordability checks. They'll guide you through the process as well, going through fixed rates, variable rates, product fees, finding the cheapest product that's available based on your circumstances. So it's well worth it, especially as some lenders, they don't actually work with you directly. They'll only work with brokers. There you have it. I hope this has really helped break down the ins and outs of buy-to-let mortgages. If you've enjoyed the video, like it so other people can find it. Subscribe to the channel, as I will be investing in another rental property in the future as well, and I want to take you guys on that journey with me. But if you do have any questions, thoughts about anything that I've gone through, please feel free to leave it down in the comments. If you do want more content like this, check out this video here where I show you around my buy-to-let property. And thank you so much for watching, and I will see you next time. Bye bye.